Welcome to The Deep Dive, the show where we cut through the noise of earnings calls to give you the signals that really matter.
And today, we are really digging into the noise.
We are. We're taking on Phoenix Education Partners, that's ticker PXED, after their Q1 fiscal 2026 results came out on January 13th.
And, the story they're trying to tell is that PXED is this durable, cash-generating machine in adult education.
But the market isn't quite buying it yet.
Not at all. And that's because this quarter, it was their first full one since the IPO back in October, and it is just riddled with these one-off accounting items. It's messy.
So our mission today is pretty clear. Separate that operational signal from all the accounting noise and figure out why the stock got absolutely punished.
Let's do it.
Okay, so let's start with the top line, the numbers that actually beat expectations.
The good news, right?
The good news. Revenue came in at $262 million. That was comfortably above the $257.6 million consensus, a solid 2.9% jump year over year.
And the adjusted earnings per share was even better. They hit $1.38, which sailed past the $1.27 consensus. That's an 8.7% beat.
And the most important metric, really, the lifeblood of the business enrollment, looked healthy.
Very healthy. Average total degreed enrollment was 85,600. That's up a solid 4.1% from last year. So, if you just stop right there, this looks like a home run.
It looks like a great quarter, but this is where things get, frankly, bizarre. Despite all those beats, the very next day, the market just hammered the stock.
Yeah, it closed down 10.47%, a brutal reaction.
And that's the disconnect we have to unpack. Why?
It all comes down to the GAAP numbers, the official by-the-book accounting profit. GAAP diluted EPS absolutely plummeted to just $0.40.
Wow, compared to what, last year?
Compared to $1.23 in the prior year. So you can see why that spooked people. That double-digit plunge in the stock price tells you the market was completely fixated on those below-the-line items.
So the fundamental performance didn't matter. It was all about the accounting.
It was all about the accounting noise.
Okay, so we have to get into the weeds. What created that massive gap between the good adjusted number and that awful GAAP number?
The main culprit was a massive, and I mean massive, non-cash share-based compensation expense. We're talking $29.5 million.
$29.5 million. Where did that come from?
It's basically an accounting cleanup from the IPO. The bulk of it, about $23 million, was from modifying all the pre-IPO stock options to get them compliant with public company rules.
So this sounds like a classic one-time thing, but for you, listening at home, maybe help us understand the difference here. Like, why should we trust the adjusted number?
It's a great question. Think of it like this. Your GAAP number is like your annual tax return. It's got everything in it, that one-time bonus, a huge medical bill, all the weird stuff.
Got it.
The adjusted EPS is more like your regular monthly paycheck. It's the clean, predictable, recurring earning power of the business. And management was very clear this is not going to be the normal run rate.
But wait a minute. If it's just IPO noise, why did the stock still drop over 10%? Are we sure we won't see more of these cleanups dragging down the headline results?
That's the skepticism right there. That's the sell first, ask questions later mentality. But if you look at the other operational metrics, the ones that aren't affected by that accounting, the strength is... it's undeniable.
Like the adjusted EBITDA.
Exactly. That's a great proxy for cash flow. It grew 7.2% to $75.2 million.
And the margin expanded too, right?
Crucially, yes. The adjusted EBITDA margin went up to 28.7% from 27.5% last year. That's real efficiency. You don't get that by accident.
And to really drive the point home, they put their money where their mouth is.
They did. They declared their first ever regular quarterly cash dividend. 21 cents a share, just like they promised at the IPO. That's a huge signal of confidence in their future cash generation.
Plus, the balance sheet looks clean. Lots of cash, no debt.
Rock solid.
Okay, so the cash is there. But what about the customers? Let's talk about the business drivers, specifically that 4.1% enrollment growth.
This is maybe the most important part of the story. Their B2B or employer-affiliated enrollment is just on a tear.
Right.
It's now at about 34% of their total enrollment. That's up from around 31% just a year ago. It's becoming the core of their business.
And they also mentioned they're getting better at weeding out fraud at the top of the funnel.
Yes. The controls they put in place last year are working. It means their enrollment reps aren't wasting time on bad leads, which makes the whole operation more productive.
This all sounds great. Better students, more corporate partners. But here's where management dropped a little bomb on the analysts.
The nuance, yes.
They said revenue growth will be, and I'm quoting here, unnaturally lower then enrollment growth for the next couple of quarters. How can getting better students lead to less revenue in the short term? That sounds completely backwards.
It does seem counterintuitive, I know, but it's actually a sign of a healthier business. Here's what's happening. Last year, they had a bunch of students sign up who didn't stick around past the first few courses.
That is high-churn students.
Exactly, but those students still paid for a little while, creating this sort of artificial short-term revenue bump in last year's numbers.
Ah, I see. So this year's students are higher quality and they persist longer.
Which is great for the long term, but it means they don't get that same short-term revenue pop from the churners. So when you compare this year to last year, the revenue per student number looks temporarily lower.
So better quality is creating a temporary headwind on the revenue line.
You got it. And that's compounded by the B2B growth, too. Those corporate partners get bigger discounts, which also pushes down the average revenue per student. It's a double whammy, but for good reasons.
Okay, that makes sense. So let's pivot to the big external risks. The things the market obsesses over: regulation, cybersecurity, and AI.
These are the big overhangs, for sure. Let's start with regulation, because the news here was actually a massive, massive positive that the market just seemed to ignore.
Right. This is all about their access to federal student aid, Title IV funds. It's their lifeblood.
It's everything. And the big news is that preliminary data from the Department of Education showed that for the majority of their programs, all of them were passing.
All of them passing. That is a huge green light. That should have sent the stock soaring.
It should have. It removes so much uncertainty. Management basically confirmed they feel very safe under the new accountability rules, which is the best news they could have possibly delivered on that front.
Okay, what about the tech side? First, the cyber issue. They had that Oracle vulnerability.
They did. They booked about $4.5 million in expenses for it in Q1. But the key things here are: it's excluded from adjusted results, it didn't impact students, and they have insurance. It's a one-time cleanup, not a permanent drag on profits.
And finally, the big one, AI. Every company has an AI strategy. What's PXED actually doing?
Their approach seems pretty smart and focused. It's two-pronged. First is for the students, making them AI fluent, which is table stakes for the workforce now.
And the second part is for their own operations.
Right. This is where they can really move the needle on margins. They're using AI for things like appointment setting in the enrollment funnel and using their own data to power 247 student chat support.
So if they can make that funnel just a little more efficient,
it flows directly to the bottom line. A 5% or 10% improvement there is huge for EBITDA.
So a strong start to the year, great news on regulation.
Yeah.
And yet they were prudent. They just reiterated their full year guidance.
Exactly. No change. Net revenue is still guided to between $1.025 and $1.035 billion. Adjusted EBITDA between $244 and $249 million. They didn't get ahead of themselves.
Which brings us right back to that 10.47% plunge. The market clearly saw something it hated.
Which leads us nicely into our This Is Not Financial Advice segment.
It certainly does. Given that reaction, it feels like the market has created an opportunity here by panicking over what seems to be short-term noise.
The reaction looks irrational. I mean, the single biggest risk to this company, that regulatory hammer, was just substantially de-risked. And when you look at the fundamentals, the stock is just plain cheap for a company growing enrollment over 4%.
So what's the outrageous but plausible trade idea here?
The idea is a straightforward directional long on PXED. You buy the fear. The thesis is that the sell-off was an overreaction to GAAP noise, and the market hasn't priced in the massive regulatory green light.
And what's the target?
The immediate target is simply a reversal back to where it was before earnings. A quick 10% plus pop back toward that $31.71 price.
What's the catalyst you'd need to see next quarter to confirm that thesis?
You need management to come out and say two things. One, that the AI pilots are actually working and improving funnel efficiency. And two, that B2B growth is still going strong, staying above that 34% level.
Okay, and what about the downside? What if the market stays irrational?
That new dividend is your safety net. That $1.21 per share every quarter provides a yield floor to the price. It gives you a cushion and pays you to wait for the market to come to its senses.
So to sum it up, PXED delivered a beat, got great news on regulation, but the stock got crushed because of IPO accounting and a temporary revenue lag.
And that's the whole story. The long-term question now is, can that confirmed regulatory safety and those AI efficiencies finally convince the market to stop punishing this stock? You have to ask yourself, is this uncertainty an opportunity, a gift? Or is the market right to be worried that this revenue lag will stick around longer than anyone thinks?
A fascinating conflict between fundamentals and market psychology. Plenty to think about there for anyone watching this space. Thanks for breaking it all down.
My pleasure. We'll see you on the next deep dive.